Hello class and welcome to a quick video example. I received a question about this stop and think example in the book. So let's read through it and understand how the calculations take place. So it says Gwen is a single taxpayer. Gwen, a single taxpayer, has seen her income climb to $190,000 in the current year. She wants a tax planner to help her reduce her tax liability. In planning for tax clients, tax professionals almost exclusively use the marginal tax rate in their analysis rather than the average tax rate. Why is the marginal tax rate much more important in the tax planning process than the average tax rate? The solution, because tax planning is done at the margin. A single taxpayer who has taxable income of 190,000 has a marginal rate of 32% at 2018 rates, but an average tax rate of 22.36%, computed as follows. So, this is their calculation, but the student asked me, how did they get to these numbers? And the answer is we have to reference a tax table. So these tax tables are in your book. I just pulled this one from the internet, but it will be the same as a 2018 individual rate tax table in your book. So let's look at it. We have taxable income of $190,000. Let's do this real quick. So we have formatting. We have $190,000. Okay. Uh, and then the example says tax on the first $157,500 of taxable income. But how do they get that? Well, what happens and what most people don't understand is you don't pay tax just in this 32% bracket that Gwen falls in, right? Because her income is between 157,500 and 200,000 at 190. But she's not going to pay a flat 32% tax on all of her income. She's actually going to pay tax in each bracket as she moves up, and she'll only pay 32% tax on the amount over 157,500. So what does that mean? So if we looked at each one of these, we would see, okay, 10% of, let's do it this way, of 9252. So 9252 0.10 equals, so that's how much she would pay on that income. So I'm going to drag this formula down so it will continue to plug in as we plug in other numbers. Now we have our next step. So we have 12%. So let's put 0.12. I'm going to go ahead and format these as percentages so it's not confusing. Well, we have 12%, but it's on the amount over 9525 up to 38,700. So if we did a formula like this in Excel, equals 38,700 minus the 9252. Okay, so she's paying 12% on $29,000 of income. Okay, now we're in the next bracket, which is a 22% bracket. Okay, so now she's going to pay 22% on the amount over 38,700, but not more than 82,500. So we're going to have 82,500 minus it's 38,700. And I believe if we were to add these two up, yeah, we would get 38,700. So we'll go equals 82,500 minus the sum of these cells above. Okay, so she's going to pay $9,636 on that amount. Now, the next bracket is a 24% bracket. So she's going to pay 24% on the amount up to 157,500, but over 82,500. So 157,500 minus the sum of the cells above this. So now that's all the tax she's paying up to 157,500. We still have to calculate the amount of tax over that, but the way that it's broken down in the problem, it shows tax on the first 157,500, and it shows $32,090. So if we add up what we've calculated so far, we get $32,094.96. Why is that? I'm sure it's because of rounding. So let's go ahead and do a round. 0 digits. So we're going to have that round to the nearest dollar. Interesting. So now we went up. That's interesting that's happening there. Now, what I would normally do is I would look at this right here. This right here tells us how much we're paying on the amounts below that. So that would be $32,090. Interestingly, we're getting something incorrect. 157,500, 157,500. Okay. 82,500. Okay. 38,700. Okay. Interesting. Okay, so let's see where if we can figure out where our where we're going wrong here. So if we add up the first two columns, it should be, or the first column should equal this, 952.50. Now if I don't round, or if I round to two decimal places, we get 9. Oh, that's why. Okay, I've typed this number in wrong. 950, 9525. Oops, 9525, 9525. Okay, there we go. So typos will mess up the whole thing, but it was easy enough to discover. Okay, so now we're at 32,089 and 50 cents. Okay, so there we match there. Now all we have to do is go 190,000 minus the sum of these, which we know is 157,500, but we'll go ahead and keep our formula. Oops, now this is a 32% bracket, and that gives us the 10,400. So if we add this amount from before plus the 10,400, we get a total of 42,049 and 50 cents. Now the problem's rounding, 42,490. So if we gave that a round function, round that sum to 0 decimal places, there we go. We'd get 42,490. Awesome. Okay, so then it says let's look at what our average tax rate is. So our average tax rate is the total amount of tax we paid divided by the total taxable income. So we will go equals the total amount of tax we paid divided by taxable income. So our average tax rate as a percentage is 22.36%. Cool. So we're not actually paying 32% on all of our income. As an average, we're paying 22.36% because of the way that we step through each tax bracket. However, every additional dollar that Gwen makes up to $200,000 is going to be taxed at 32%. So that's why when we're doing tax planning, we're looking at the marginal rate, because if we can get deductions, or if we make extra dollars, we're saving, or we're spending an extra that 32%, because that's the tax bracket that all that activity is going to take place in. If we were somehow able to get deductions below 157,500, additional deductions would only save us 24%. However, if we made additional money over 200,000, then additional income over 200,000 would cost us 35% in tax. So that's why when we're doing tax planning, we're utilizing the marginal rate, So the question says, or the example says, if a tax planner could reduce Gwen's taxable income by $10,000, Gwen's tax liability would decrease by 3,200, 10,000 times the 32% rate that she's currently living in. When the taxpayer wants to know how much she can save through tax planning, the appropriate marginal tax rate yields the answer. So we wouldn't use our average tax rate for planning purposes. We would use the marginal rate for the bracket that the taxpayer is currently living in based on that tax planning strategy. But we have to know that that can be bumped into other brackets as we cross these thresholds right here. So as we cross these thresholds, that marginal rate can change. Okay, well, thank you so much for viewing this video. I hope that makes sense to you. Thank you, and have a blessed week, and please send me your questions.